Oh, no.
Hi, Amanda.
Okay. Thanks so much for joining us. For those of you who don't know Darlene Espinoza, she is one of the best lenders out there. With over 20 years of experience, I cannot tell you how many times this woman has saved my behind in a bad transaction situation. So I'm super excited that she has agreed to take the time to kind of share her knowledge with us today. Thanks so much, Darlene, for coming to the stage.
My pleasure. Happy to be here.
So really, the idea of today's mastermind is to help position agents to be better partners to their lender partners and also to better vet their lender partners to make sure that you're connecting your clients with the best possible person for the job. So, Darlene, from your perspective, what do you think that we as real estate agents should be sure to share with our clients in that initial buyer consultation in order to prepare them for success when they work with you or our preferred lender?
Great question. I think that it should come from the basis of the realtor knowing who they choose to partner with. For the lender to represent them will either be a point of strength in that offer or a point of weakness in the offer where something falls apart in the 12th hour. Also important to know for buyers, if a realtor can re-emphasize to the buyers to tell us everything. And if they're co-signing for somebody on a loan and it's not on the credit report, don't think that because it's not there, we're not going to find out about it. We typically do. And there's usually solutions for it, but you don't want to find out a challenge in the 12th hour of a loan. So I would highly recommend that you have your clients be completely honest, tell us everything, because once we know what the file, any challenges or triggers that the file may have, we know how to navigate through the maze. We know which investors are going to be a better match for that loan. And there's usually solutions for most challenges. The other thing is have the clients get their documentation to us quickly. A lot of times a client goes into contract, they've already been pre-approved weeks or months prior, and then they go into contract and we need certain things updated, their income or their asset documentation. But because they're in contract, they just don't send it to us as quickly. And we're constantly reaching out because we can't move forward without that. So timing is of essence on getting those documents into.
I like it. And I will tell you, one of the questions I get most often, especially from agents who are maybe a little bit less seasoned, is what questions should they be asking of a lender as a listing agent when they are vetting potential offers on their listing?
That's another great question, Jessica. I'll tell you that as a lender, when I have a client who makes an offer, I actually reach out to the listing agent when that loan approval letter goes with the offer and it's submitted. I reach out to the listing agent, introduce myself, put a voice behind this loan approval that they have. I talk about the strength of the buyer's file. I offer them my cell phone number because most offers are presented at night to the sellers. In the event there's any questions or concerns in the evening hours, that they'll be able to reach me. And the reason I do that, because in today's world, you have to be able to reach out and talk to somebody. You don't want to be calling a phone number only to have an automated voice box telling you to press 1 or press 2 for certain departments. It's very frustrating. So you want to be able to reach them. And the other important thing would be to understand the difference. Most offers that are written, I believe it's been, I've seen statistics that over 60% of offers that are written with a buyer's loan letter that's a pre-qualification and not even a formal loan approval. It hasn't been underwritten at all. And that's why we see like a third of transactions fall apart in the 11th hour.
So I really like that you said that, because that's always my biggest concern as a listing agent. And maybe for some people that are watching us today, they may not be super familiar with what that means. So if we could just break it down to the bare bones, my understanding is that once we say a file has been, quote, underwritten, that means that the loan file has been completely verified, reviewed, and approved by the underwriting department. That borrower's income, assets, credit, debt, all of those things have been fully approved, and the only thing we're waiting on is the actual property and appraisal. Is that accurate?
And of course, the title report.
In
Absolutely
the title
correct.
report. Great. And I think this is critical, guys, because we see this happen where you end up going into contract. You've got this letter that says this buyer is approved up to 500,000, and it turns out that that's just based on what the buyer thought they made, but maybe they didn't realize that their overtime doesn't count or that commission didn't count. And when it actually comes down to it, in the 12th hour, their earnest money deposit is on the line and their heart is broken because we didn't partner with the right person. So it's really, really important that you understand that. And I think it usually, and Darlene, correct me if I'm wrong, this should be pretty clear to us because there should be language in the letter itself somewhere that says, hey, this approval is subject to the review and approval of our underwriting department. Is that kind of
Yes.
the red flag phrase?
Yes, and if you look at loan approval letters that typically come in, it'll typically say an appraisal, a title report, and a contract is needed. But if you look in the smaller print, either at the top of the letter or the bottom of the letter, it will say this approval is based on the review and acceptance of the underwriter reviewing income, assets, credit, cash to close, the season of the money. So that's how things fall apart. Most lenders will do something called an automated underwrite. And that's what happens when a buyer applies online. The buyer plugs in their information. They answer the questions because they don't know how income is calculated. They're just going to base it on what their W-2 said or what they make per hour. But there's more to it than that when you underwrite a file. And it goes through an automated underwriting system. They have an answer within 2 minutes and the file is approved. And that's what most lenders use when they write loan approval letters. The problem is incorrect data going in means the results are going to be incorrect also. And if I could mention something else, Jessica, you brought up about having a frustrated buyer at the end when something like that happens. But I think it also reflects on the agent as well and the reputation of the buyer's agent in the transaction.
I think that's 100% true because I can tell you from experience as the listing agent, I remember the buyer's agents whose deals fell apart the day before settlement. I remember those agents. And it's impossible not to because those are the most painful losses, right? You really don't want to put yourself in a position to have your reputation hanging upon the performance of someone who you haven't vetted. And I think that's really, in my opinion, the nuts and bolts bottom line of this. You have to know how to vet the person that you're partnering with on the lending side.
Absolutely.
And actually, to that end, I think what a lot of people maybe don't consider or understand is the various types of lenders out there.
Mm-hmm.
Can you tell us a little bit about that? Like, give us the high level overview of how we should be looking at these different lender types.
Sure. So you have the banks, the brick and mortar that you can walk into, the retail bank where you have your checking savings account. You could apply for a mortgage there. That's considered a retail bank. You could also apply online to an online bank. You can apply to a mortgage broker who brokers to outside banks. You can apply to a mortgage bank who lends money, and that's all they do, 100%, and they carry the debt on their own books. And you could also have what's called a correspondent lender, and that's a mortgage bank who underwrites their own loans, but also has the ability and is qualified to underwrite on behalf of the retail banks, the big box banks that are on the outside. So for instance, Cross Country Mortgage, we wear all hats. So we're not a retail bank in the sense of having checking and savings, but we lend our own money. We service a lot of our own portfolio of loans. We also broker out to outside banks in the event we need something out of the box than traditional lending. And we do something called correspondent lending, which means we're authorized and we're fully vetted to be able to underwrite on behalf of the big banks, like Bank of America, Chase, Citi, the big banks, so that a person doesn't have to keep applying at multiple sources for their bank. Once they're approved, we have them approved at all. It's a big advantage when they're out there shopping for a home.
I like that a lot. And so I think an important question to ask when you're evaluating a lender is what type of lender they work for, right? What type of lending company they work for, because the power in working with a correspondent lender is huge. You now have the option to have your file fully underwritten, but not necessarily committed to an individual product until you find the right house, which means your client has more opportunity to get the best possible deal of that moment. At least that's my understanding. Would you say that's a fair assessment, Darlene?
Absolutely.
Love that.
Yes, absolutely. A good example would be that we know interest rates change every day, all day when the stock market's open. Interest rates are based on the yield of conservative investments like treasuries and bonds. So if we pre-approve a buyer today for a loan and they're out there shopping, it may be weeks before they buy. It could be a year before they find the right house. And when they do go into contract, if we were only able to stay with that original loan approval, we would have to go to that bank for the rates that that bank had at that day. Being a correspondent lender like ourselves, we have the ability to navigate that loan to any of the banks, still fund it quickly, carry it on our books, and then after transfer the loan after it closes. So it allows for smooth, efficient closing in a quick, timely fashion. In some cases, we close purchases within 10 days.
I love that. And I think it's really important to know that you have that ability with the right lender, especially in these markets right now where we're really going into a seller's market in a lot of markets across our country right now. Inventory is super tight and demand has really been ticking upward as people have anticipated lower interest rates on the rise, right? There's a lot of talk that cash is king because time is of the essence. So if a cash buyer comes in and says, I can close in 10 days, you get to say, I can close in 10 days too.
Yeah, if
You
the
can
loan's
be
been
just as
pre-approved.
competitive. Well,
Yes.
yes, if your loan is fully pre-approved with your correspondent lender, somebody like Darlene with Cross Country Mortgage, because again, who you work with is either a point of strength or a point of weakness in your offer. And I think that's really the take-home message here.
Yeah, something I'd like to comment on, Jessica. You mentioned cash is king.
Mm-hmm.
It just brought up what could be a big red flag for buyers is that a lot of people don't keep their money in the bank, or they save their money in home vaults and they have cash. People call it mattress money.
Mattress money, yes.
Yes, can't use that for a purchase. As a buyer, that money has to be in a bank account and seasoned for at least 2 months, 60 days, before it could be used for a mortgage transaction. So that's going to be really important. When you said cash is king, I thought, wait a minute, not when you're getting a loan.
Yeah, and that does come up. And unfortunately, that's something that will come up with some of these automated approvals, right? Because they're going to ask you what your reserves are. And the borrower, not understanding that requirement, is going to say, oh, I have $200,000 cash. That's my reserves. No, it isn't, because you have $1,700 in your savings account, and that's all that counts. Not a huge deal if you're planning ahead, right? You can put that money in a bank. You can allow it to season over the course of the next 2 months. But if you're not realizing that's a problem until you're already in contract, it becomes a big problem.
Yes, absolutely.
So, that's a great note. So thank you for saying that. And actually, with that, I would love to talk about, just kind of the myths that are out there. I feel like I hear a lot of stories about real estate, about lending that I know for a fact are not true. And I would like you to validate me and help explain it from a lender's perspective. So first thing I hear all the time, when you're ready to buy a house, you're going to need a 20% down payment.
I hear that all the time, and that is a myth. You don't need 20% down. You can go in with as little as 3% down on a conventional loan. There's lots of programs available. So having 20%, is going to be no. It'll just make their payment lower.
Right. Another one that I heard recently is FHA financing is reserved for first-time home buyers. Have you heard that one before?
People do think that. They think it's for first-time home buyers. And the fact of the matter is anyone can get an FHA loan. You don't have to be a first-time home buyer. You just have to live in the property as your primary residence.
Here's a big one, and I take this one very personally as someone with a VA mortgage. I hear that VA loans are bad. No seller should consider accepting a VA finance offer. What do you think about that?
Definitely false. I will tell you, one of the questions when I vet buyers, when I'm taking their loan apps, is I ask them, is anybody in the transaction a veteran? The reason for that, those are the best loans to get. There's so much benefits to a VA mortgage loan. Number one, the rates are going to be lower. Number two, you can go in with 0% down and you have no private mortgage insurance requirement on it. And they allow lower credit scores and higher ratios. And we should have better products available for veterans to help them. They've served our country. Realtors used to think that VA loans were difficult and that the seller had to pay a large portion of the buyer's closing costs. Years ago, prior to 2012, that was correct, but not anymore.
Love that. Thank you for clarifying, because it drives me nuts. And it's one of those things that I think, it's a story as old as time, and it's been passed down from generation to generation of agents. And when a younger agent today hears someone that they consider very seasoned or experienced saying, oh, you should never consider a VA financed offer, they believe them. And unfortunately, that agent maybe hasn't done the best job of keeping up with what's happening in the mortgage market, and they're basing that opinion off something that is totally outdated and not even accurate anymore. So for those of you that are here, VA loans are A-okay. One of the other things, oh, sorry, go ahead.
No, I was just going to say, I'll say a little plug here, if that's all right, Jessica.
Yeah.
What you just said about some seasoned realtors may not know that guidelines have changed, and guidelines change with banks on a weekly basis. And that's why I teach a class once a month. I call it Lending 101. It's a online Zoom class where realtors can learn about different programs that are out, and they can ask these type of questions so that they feel confident when they're getting these letters and reviewing them with their potential sellers.
I love that. So as you were saying that, I put a little ticker up on the bottom. I'm going to make sure that we include that information in our follow-up email today, because I think that that is something that is critical. And it really is our job, you guys, to understand what's happening. It's not our job to do it, but it is our job to understand it, because you can't ever hold somebody accountable to something you don't understand. So really, really keep that in mind. In my opinion, you got to do it. Another myth that I've had this conversation twice in the last 60 days, and it's terrifying to me, but what I'm hearing is that there are investors out there buying investment property who seem to be under the impression that the best way for them to save money is to go ahead and indicate on the contract that it's a primary residence. What do you think about that?
Ooh, that is so bad and so false. It's actually a federal offense. And Jessica, I see this at least once a month in different markets. I lend in every state in the United States, so I don't always know. Sometimes I know the buyer, and then the buyer introduces me to their agent. So I don't always know the agents well. But I've had it where contracts are written primary occupancy, and I know it's not going to be a primary occupant. They're going to rent it out. They have full intention out of the gate to rent the property out. I will tell you that it's a federal offense. Person can go to jail for it. Not only can that person, the realtors involved, it causes problems for the title company, the banks, and the government track every agent, every license number, the appraiser's license, the escrow officer's license. And when they start to see patterns, you have problems. So if a buyer is going to buy it to rent it out, I tell them, you're investing so much money, buy it correctly, put the larger down payment. Yes, you're going to have a higher interest rate, but protect your asset, because if you falsify that and the banks were to find out, they would recall the loan. So not only would you lose the property that you purchased, you would lose any investment that you put into it. You would have cost with attorney fees. You'd go to jail. Just don't do it. Just advise your clients to be truthful. And for the agents, it's their reputation as well.
I 100% agree. I'm so glad that you are on my side on this. Hashtag
I'm
loan fraud, not a good idea.
Yes. I want to share one more fact there. There are companies out there that the government uses to investigate these, and they just pick them at random because they know there is a lot of loan fraud with people buying primary residences who don't live in them. And they can check up to a year later, but they'll look at utility bills. They've even knocked on neighbors' doors to see who lives in this home. It's a big problem in the US, and yeah, good fact to bring up.
I like it. I'm going to keep going through my list here. I have a ton of things, and I got to confess, I did ask some of our viewers to send me some questions they had, and some of these questions I think are really just a matter of misunderstandings. So this person asked, is it true you need at least a 700 credit score to purchase a home?
No, that's not true. You can buy a home with as little as a 500 credit score. If you have 10% down using an FHA product, you can get a conventional loan with at least a 620 credit score. There's a lot of what we call lenders, out of the box lenders, that will allow the credit scores to be lower. The credit profile still has to be good. Keeping in mind, a lot of times people's credit scores are low because they have a lot of debt. It doesn't mean that they have late payments and such. So it's best to let us talk to the borrower and see what the whole scenario is.
Okay, I like that a lot. Speaking of, I also recently heard that if you're interested in purchasing a multi-unit residential property, that you have to have at least 25% down, meaning if you want to buy a duplex as a primary resident and rent out the other half to offset the cost of your mortgage, you now have to have 25% down payment. What say you, Darlene?
Well, because we're doing this today, that would be false. That's a myth. If we were doing this class or this video 3 months ago, it would have been true. So guidelines have changed. Now, a primary resident, if the person is going to live in one of the units, they can buy up to a 4-unit with 5% down. They have to qualify for the loan, of course, but they would have the potential rental income of the other 3 units to help them. It's a great investment and a great way for a buyer to create future wealth with real estate.
100%. Like, that is a house hack if I ever heard one. And my last myth that I need you to bust for me, please. It's better for buyers to wait to buy until the interest rates come down.
No. I hear this so much. Yes, we're going to wait to buy. We know interest rates are going to come down. We're forecasting, most forecasters and economists believe it'll be by the second quarter, the end of the second quarter. At that point, as rates come down, purchase prices go up, because right now there are a lot of people sitting on the fence because rates have been high. And quite honestly, if I could say, we had the highest peak in rates maybe a month and a half, 2 months ago, where rates went above 8%. And when a person would ask me then, is now a good time to buy? It was absolutely, it's the best time to buy, as long as you could afford the monthly mortgage payment. But best time to buy because when rates are high, you're competing with fewer people for that same property. And inventory is always an issue in the United States. Lack of inventory is always an issue. So it's a buyer's market when rates are high because they could negotiate closing costs. They could negotiate buy downs on rates and a lower purchase price as compared to when rates come down. Now it's going to cost them more for that home. So there's a cost of waiting. Gosh, I mean, if we just make an illustration of just, let's say, a home price of $500,000, if somebody was to wait a year to buy it, even using forecasted national appreciation of 5%, that buyer has lost $25,000 of appreciation if they wait. Not only have they lost that, they're paying $25,000 higher for the house, which means higher property taxes too. So now's a wonderful time to buy.
I love that. And actually, obviously, we're not ready to show it here at this exact moment, but you have shown me before a really cool program that you have that's like a rent versus buy calculator for property specific analysis, right?
Yes.
So let's say you're buying 123 Main Street or you're thinking about it.
Yeah.
Darlene's got this cool tool here where you can say, 123 Main Street is listed at $650,000. I'd be willing to buy it today at $700,000, but I could rent a very similar property for $3,000 a month. She can literally break it down for you to the extent of, okay, how much cash out of pocket are you putting into this thing versus what you would be investing as a renter, right? Because that $3,000 a month is just gone. And she calculates, okay, let's look at the tax savings. Let's look at the appreciation, and let's calculate your return on investment / lost opportunity. If you were to say, keep this home for the next 5, 7, 9, 10 years, what would your net profit look like versus your net loss? And it's such a powerful tool, especially for your analytical buyers, to help them understand why it doesn't make sense to wait. So I'm sorry that I just let that genie out of the bottle, Darlene, but with your permission, I would love to share that with our viewers too in the follow-up content.
Yeah, absolutely. Love to be able to do that.
Love it. Well, it's about that time, you guys. I really, really appreciate those of you that came to watch us live. If you're watching us on a replay, always feel free to reach out if you have questions. But again, this is Darlene Espinoza with Cross Country Mortgage, more than 20 years of experience and just an incredible professional. So thank you so much for sharing your knowledge with us today.
My pleasure. Thank you for having me, Jessica.